Hello, everyone, and welcome to another one of our financial wellness webinars. Today, we are going to be trying out a different format than our usual. Historically, we have been doing 1 hour webinars, usually bringing in a professional from a different part of our industry or something tangential to financial planning. So we have done previous webinars with on estate planning with partners from local estate planning firms. We have done some on Social Security timing. We've done some on 529s. Today, we're going to be doing a short video on the major update in our industry with taxes, the big, beautiful bill. So there's a lot in there. I'm not planning on going all through it today. Just want to talk about what things will be impacting our clients. What are we looking out for? What will we be reaching out to individuals about? And things that people should be considering. A lot of the things in this bill is just making permanent previous tax laws, though there are certainly new things that are being introduced that would be worth either looking to take advantage of or to be aware of that nothing happens with what our current strategies are. So this webinar will be available on our website. We're going to send it out to clients who are interested, but it'll also be available on our website under a client center where we've been keeping all of the other ones. So I would encourage you, if you're looking for this, to also go through some of the other webinars that we've had available. There's a lot of different topics, and our plan is to continue offering these for these kinds of major updates, like a tax overhaul. So with that, I'm going to share my screen here and I'll walk through our presentation. So as I said, we're not planning on going over the whole bill here, not planning on making too much commentary on it, just looking at what will be impacting our client base. So a big one, as I talked about, there's a lot of the current tax law that went through in the initial Trump administration had a sunset provision, meaning at the end of this year, a lot of the things would revert back to the old rates. Some of the changes that, again, were set to sunset were lower tax rates, as well as changes to, and I'll go over this, but estate tax rules, some corporate rules. So we have been planning to try to have people take money out and pay taxes if they were in lower rates available now, with the concern that rates would go back up starting the end of this year. At least for now, they've made them permanent. So the current tax brackets starting with 0 and then 10 and 12 and going up to the 37 are remaining unchanged. There are some adjustments for inflation inside each of those, but that is also standard. A big one for New Hampshire clients is you also had a dividends and interest tax. That is going to be fully repealed this year. They had been being reduced previously. Every year there's a little bit of reduction that has now been fully repealed. Not part of the big, beautiful bill, but certainly a tax change that's affecting our clients. Another change is, well, another thing staying the same, if you will, is the standard deduction. So it is getting a little bit of an increase. A lot of that, though, is tied to, more just cost of living increases. So for single filers, 15,000, married filing jointly, it's 30,000, or head of households, 22,500. So this does mean, the first, in this case, for married filing jointly, the first 30,000 of income is not taxed. And then after that, you're hitting the 10% bracket, 12%, and so on. These changes and many of the things they will talk about today, while they maybe have been pushed past the sunset date, is only through 2028. So there's some things in the bill that are permanent and some things like the standard deduction, as well as some of the next things I'll go over for $6,000 increase for seniors, really only go for the next 3 years. So this is what I'm referring to, the enhanced deduction for seniors. So taxpayers over the age of 65 will now receive an additional $6,000 deduction. Now, this is meant to satisfy the campaigning that we would be able to make Social Security benefits not taxable. So this does not directly reduce your Social Security income or the tax that you pay on them. Instead, it's 6,000 worth of your taxable income is deducted. And so for many Americans who are living only on Social Security or on Social Security and some smaller would be pension or IRA income. This will offset, if not, or significantly reduce income they would be paying taxes on. So effectively, it's trying to, for most Americans, reduce the tax they pay on their Social Security benefit. Again, a few key items. You have to be 65 and older. There is also an income limit. So for higher income earners, if you have married filing jointly, for instance, if you have income between 150 and 250,000, you're either phased out or over 250, you do not receive this benefit. This is also another one that is only for the next 3 years. So some things that this is having an impact for decisions we're making. One, if we have a client who is 65 or older, and initially our plan maybe is to wait till 70 to collect Social Security, we may consider having them collect sooner because they get the 6,000 now and only for the next 3 years. So if they're in a low income bracket and they would receive the 6,000, they're below the 175 or the 250 number below here, then we may consider having them start a little bit earlier because they could get a tax-free or substantially less tax on their benefit. Another portion that I think most of people were not aware of is part of the way Social Security's trust fund is filled is both your payroll taxes, but also some of the tax that's paid from benefits. So it's a lot of tax paid into Social Security. When you're working, you're paying into it, and when you're getting your benefit, you're paying into it. So by eliminating the majority of Americans who are paying into it from their benefit, mostly baby boomers, that will have an impact on how long the trust fund lasts. This is not a Social Security webinar. We have done one of those. On a high level, though, if the trust fund runs out, it does not mean Social Security disappears. It just means that you would get 75 cents of every dollar promised to you on your Social Security statement because there's still people paying in to Social Security. So even if, in this instance, the baby boomer generation who's retired and is collecting has stopped paying in because their benefit is tax-free or they're paying less tax on it, which some of them are still paying all the tax, there's still another generation or multiple generations paying into Social Security, so that money would still be available. Tips, overtime, for instance, both received, again, a campaign promise here that they would be able to deduct, well, that they would be tax-free. Again, there's some limitations here. There's phase outs, and there's also up to a certain amount of income that can be deducted from your taxes. So just, if most people who were receiving tips were probably doing their own taxes, it may be worth talking to an accountant this year, or if you do TurboTax or something like that, buying up an extra level for this year to make sure that you are correctly putting in or excluding what you should be, because there's a lot of caveats around this one. Another interesting update is auto loan interest for up to 10,000 per year is available for individuals. Again, there is a phase out on this. What we've also seen in a few places is it's not just for US cars, it's US assembled vehicles. As I said, if you're planning on buying a car, this would be a good time to consider it. It goes from 25 again through 2028. So for those clients who are looking to buy a new car, if that makes sense for them, and sometimes that's business owning clients and things like that. But this would be a good opportunity if you're trying to get a deduction on the interest. There is also, and I'll go into this later slides, for people who are looking at buying electric vehicles. This is the year to be considering that because on the flip side of this, some of these things are getting phased out. Another benefit that exists and is now just being extended is what they call QBI deduction. So this tends to be for business owners. There's a certain amount of their income that they're able to pass through and deduct. So I've actually seen different tax accounts making recommendations to say maybe you should consider changing the structure of your or the way that your business is taxed to take advantage of this. Initially, people were not making changes because it was not a permanent decision, but making the changes to your business had a very large impact. And now where this may be here for 10 years, it could be worth considering making that change. So another question for an accountant is if this affects you and as a business owner. Beginning in 2027, There's going to be the ability to claim a credit for up to 1,700 for qualified donations to nonprofit organizations, and that supports our scholarships for K through 12 and private school education. Another note with this too is that is a credit, which is a little bit more of a powerful thing than a deduction. So deduction reduces your income, but then you pay tax on a certain percentage of that income. So it doesn't reduce your full tax bill, just a portion of it. A credit, if you have a $1,700 credit, you're paying 1,700 less dollars in taxes. Whereas if you have a $1,700 deduction and you are in, let's say, the 22% bracket, then it's a $374 reduction in your tax bill. So as you can see, credits can be much more powerful. State and local tax deductions. So this was a big change previously for people. They were trying to make more people itemize their taxes. And so the standard deduction, which we went over earlier, was increased substantially. So have more people use that rather than itemize. And another way that was significantly capped, especially for states with high taxes, is that initially you could only deduct up to $10,000 of state and local taxes. That number has now been increased substantially to 40,000. Once again, there is an income limit on this, and there's a certain threshold. You can see here the income threshold will increase 1% each year through 2029. This one also has a little bit of an odd phase out. So they made the 10,000 that initially is effectively permanent, but from now until 2030, you can actually do up to 40,000. So from now until 2030, it's 40,000. From 2030 on, it's set to be 10,000 again. So this is something that would help our clients, particularly in places, New York and Massachusetts, are the two states close to us with very high taxes that clients were capped at the 10,000. As I mentioned earlier as well, there's going to be some reduction in tax benefits, particularly in the EV space, electric vehicles. So there were some credits out there for new and used electric vehicles. And as I said, these are credits. As we talked about, those are a lot more powerful than even deductions. So those will still be good until 2020 through September 30th of 2025. So also, if I have someone that is considering purchasing a car, again, the question becomes, should they be buying new, if depending on their tax bracket, to deduct the interest, uh, which most clients don't buy new, but something that's important to consider, as well as the electric vehicle, right, through September 30th. If that's the route they want to go, a $7,500 or $4,000 credit has a huge impact on taxes. And then finally, the energy efficient home improvement credit, right? Think solar panels. That's something that's also set now to be phased out the end of this year. So for those who are interested, again, that would be the time to move on that. There's been some other benefits here. For parents, so there's the child tax credit. They're going to be increasing that. So for qualified dependents that you claim on your tax returns, you'll actually be seeing an increase in the total credit, and there's still a portion of it that will be refundable, meaning if you don't use the whole credit, you can actually get it added onto your refund. Most deductions and credits, if they bring your taxes to zero, even if there's more you could have taken, there's no benefit, you just don't pay your tax. And again, in this instance, if it brings it below zero, then you can actually get a refund based solely on this kind of a credit. There is also something referred to as a Trump account. So it's a one-time payment of $1,000. The government deposits it into a tax-deferred investment account, kind of like an IRA, not exactly, but kind of like an IRA for children born between January 1st of 25 and December 31st of 2028. So again, another one of these 3-year options. It's automatically enrolled. So once your child is issued a Social Security number, they're part of the accounts. It's not clear to me if there's an option to opt out, though I don't know how many people would want to. Then it is invested in a U.S. stock index, and they're saying effectively if the money went in and it was never touched until 18, if you use a 7% rate of return, which is probably appropriate, If it's in a US stock fund and you don't touch it for 18 years, it could be worth 3,500. As I said, if you don't touch it, if you don't do anything with it, there are the options to do things with this money though. As you can see here, you can use it for education, a home down payment, buying a business. Those are things where it'd be taxed at long-term capital gains rates. So not quite the same thing as a 529. And then there are the options to have a non-qualified, so you could just take the money and run, but there are similar to IRAs and 529s and other tax protected things. There's both ordinary income and a penalty if you take it for something that was not designed for a non-qualified distribution. You also have the ability to contribute. So family members can contribute up to 5,000 a year into a child's account. You know, it would be worth talking to an accountant, talking to a financial advisor before making a decision, do I add to this account or should I be looking at something else for the child, like a 529 or a custodial account? There's also been some significant changes in the student loan arena. I will say that's been up in the air anyway for the last 6 months or so. But some of the changes here, they're simplifying the number of repayment options. Now, simplifying is a generous way to put it. It's eliminating certain options that people were already in or were applying for, and so it will have a substantial change on how people are able to afford college and those who already have loans, how they'll be able to repay them. So the new borrowers will only have two options, a standard repayment plan and a new income-driven plan called the repayment assistance plan. And so at some point, we'll put out more information on those, but at least the standard payment plan, it's 10 years, amortized evenly over those 10 years, where some of these other options that are being eliminated, so current borrowers will lose access to existing plans. Um, the pay as you earn, income contingent plan, save, and there's a few others. Those were 20, 25 years based on your income. If you didn't pay them back, at the end of the 20 years, because your income was never high enough to warrant a full payments, then it would be forgiven after that time. So it's a pretty significant shift. Uh, Starting next year, new federal student loan limits will occur. So graduate students can borrow up to 20,500 per year or 50,000 per year for professional programs, med school, law school, with a lifetime cap of either 100,000 for general graduate level education or 200,000 for professional programs. What is a scary thing to consider is right now, 200,000 does not cover most medical school or law school graduate programs. So there's going to be some questions around how that differential be funded. Parents can also borrow up to 20,000 per year for Parent Plus loans with a cap of 65,000 per student. And current students will be allowed to keep borrowing under existing higher limits and continue using Graduate Plus loans, which will be limited for new borrowers again starting in July of next year. There's been an expansion in the Pell Grants, though. Starting July 1st, 2026, students in short-term vocational training programs can now receive what's called a workforce Pell Grant. And eligible programs must be 150 to 600 hours and last between 8 to 15 weeks, among other criteria. So this again has significant changes that we've seen, and a lot of these changes had already been impacted. I had many people who were trying to enroll or make changes in what program they were using for their student loans, where they're trying to go to income-based or some other consolidation method, and they lost that ability. And about 2 months ago, they lost the ability, but weren't told what they could do. So this does add some clarity, and it's something it's definitely worth reaching out to a professional to discuss your options. There's been changes to the federal benefits. So uh, Medicaid will now require most adults between 19 and 64 to work at least 80 hours per month. Exemptions there are certain exemptions on here. Again, this is something where, if you are on Medicaid or applying for Medicaid, we do typically work with a licensed attorney in your state because there can be a lot of moving parts. So I'm not going to go too deep into some of these details. but there's going to be a similar change for SNAP or food stamps. Will also have a expanded work requirement. So, as I said, the main impact here is what's going to impact your clients, what changes should be made, what things should we continue to take advantage on. So, again, here, looking at itemized versus standard deduction. Previously, the goal was to make as many people take the standard deduction as possible. So, they increased the standard substantially. So, you'd have to come up with a lot of different deductible items to make it worth your time to go over the standard deduction. And another way to do that is they reduced most people's largest itemization, which were things like their property tax, the mortgage interest, state taxes. So most people spent the last 4 to 6 years on standard deduction and it itemized before. You might want to consider itemizing again now that that SALT cap, as they call it, is going from 10 to 40 for the next couple of years. For those seniors who are over 65, again, it'd be looking to see should you be churning on Social Security sooner? Or maybe a spouse who has a lower benefit churns theirs on and we let yours grow. So certainly a question for the advisor. Again, most people's full retirement age who haven't started collecting is 67. So it is going to depend on your age. 65 might not be the driving age. But we're going to have to look because it's also something that's only good for the next 3 years unless something changes. Families, so not necessarily saying let the child tax credit or the Trump accounts or any of that stuff dictate the size of your family, but there are benefits out there. There's also in New Hampshire, again, looking at maybe not some from the BBB, the Big Beautiful Bill, but there's been some changes to education credits and education benefits and accounts. So something to look at. Small business owners, there's this permanent QBI deduction in place. Didn't go into this, but it'd be worth talking to your accountant. There's some major benefits for depreciation in one, you can take it all in 1 year. There's some research and development credits that you can be considering to take if you have cars or vehicles as part of your business or for personal, but you use for business. You can also be looking at should you be buying cars based on the credits going away or the new deductions. And then tax strategy. With rates, now we have an idea of at least what will rates look like for the next couple of years. Should we be starting or stopping strategies for Roth conversions, capital gains harvesting, and with certain clients, there's different options we're looking at for estate plan benefits, things like that. A lot of these may not need to change, or maybe we accelerate because now we know we've got another 5 years to get things done. So as I said, this will all be available online. If you have more questions, here are the sources that we've used, but you can also feel free to reach out to us or your accountant with follow-up questions.